The revaluation of the Iraqi dinar, also known as the IQD, is a complex and multifaceted process involving several layers of economic, monetary, and geopolitical considerations that converge around the policy decisions made by the Central Bank of Iraq (CBI). The CBI exchange rate is central to this process as it sets the official value of the dinar against foreign currencies, most notably the United States dollar. The revaluation, or RV as it is commonly referred to by investors and currency watchers, is the theoretical upward adjustment in the value of the IQD against foreign currencies. This adjustment, if implemented, would result in a lower number of dinars being required to purchase a unit of foreign currency, thereby increasing the purchasing power of the dinar both domestically and internationally. However, such a change is neither simple nor arbitrary. It is bound to the health of the Iraqi economy, the strength of its foreign currency reserves, the efficiency of its monetary system, the ability to stabilize inflation, and the trust of the international financial community in Iraq's long-term fiscal discipline. To understand how this works, it is crucial to look at the CBI's role. The central bank is responsible for implementing monetary policy, maintaining price stability, controlling inflation, managing foreign exchange reserves, and regulating the banking sector. Its exchange rate policy has traditionally pegged the dinar to the US dollar at a fixed or crawling peg rate. The official rate has experienced adjustments over the years, for example, the significant devaluation in December 2020, when the rate was moved from around 1182 IQD per dollar to 1450 IQD per dollar in response to a drop in oil revenues and a need to stabilize public finances. As of mid-2025, the official CBI rate remains at 1320 IQD per dollar, while the market rate has fluctuated between 139,000 and 140,000 IQD per $100, indicating a narrow but persistent gap between the official and parallel market exchange rates. This gap is a crucial indicator of the market's perception of the dinar's real value and reflects challenges in maintaining capital controls, curbing smuggling, financing trade, and ensuring supply and demand stability within Iraq's dollar-based economy. For the dinar to revalue upward, the first requirement is for the CBI to accumulate significant foreign currency reserves to support the currency in the event of market pressures. Currently, Iraq's reserves are above $100 billion, including over 130 tons of gold, which gives the country a strong buffer to defend its exchange rate and support the economy in times of external shocks. These reserves are derived mainly from oil exports, which make up over 90% of government revenues and a large share of GDP. While this is a strength, it is also a vulnerability because it ties the fate of the dinar to oil prices and the stability of global energy markets. Second, the CBI must ensure monetary and fiscal coordination with the ministry. The Central Bank of Iraq, CBI's announcement on June 2, 2025, confirming over $100 billion in reserves and more than 163 tons of gold, directly contradicts recent rumors about a financial or liquidity crisis. This development is especially significant for Iraqi dinar IQD holders, both inside and outside Iraq, who have grown concerned over news of liquidity shortages, public financial strain, and delayed reforms. Below is a detailed explanation of why dinar holders should not sell their shares now, based on current indicators and economic logic. CBI confirmation: no liquidity crisis. The CBI's own statement is clear. Liquidity is fully available, whether in Iraqi dinars or US dollars, and there is no shortage in this regard. Mohammed Yunus, Director General of Investments at CBI. This means Iraq is not printing unsupported currency. There is no imminent risk of currency collapse. Both domestic, IQD, and foreign, USD, liquidity is stable, maintained through reserves. Investor note: if Iraq were truly in a fiscal or monetary collapse, the CBI would not disclose large foreign reserves and gold holdings. Their transparency here is an effort to reassure markets and investors, including dinar holders. 2. Reserves surpass $100 billion, a shield for the dinar. With over $100 billion in reserves, Iraq can easily defend its exchange rate during currency pressures. The central bank can continue to fund imports, pay for essential government spending, and support monetary reforms. The reserve acts as a backstop for a future dinar revaluation, RV, helping instill international confidence in Iraq's monetary future. This level of reserve also places Iraq above many other oil exporting nations in per capita reserve terms, especially considering its still emerging economy. 3. Gold holdings, over 163 tons. The CBI holds 163 plus metric tons of gold, making Iraq a top-tier gold holder in the Middle East, a participant in global monetary trends of de-dollarization, and increasing reliance on real assets like gold, a hedge against USD inflation or instability, backing for the IQD during monetary tightening or exchange rate transition. Many believe Iraq may eventually peg the dinar to a gold-based or basket system instead of relying exclusively on the USD. If that happens, gold reserves will be vital for valuation and beneficial to long-term dinar holders. 4. Dinar liquidity issue is temporary, not structural. While the Ministry of Finance admitted to short-term challenges, they do not call this a financial crisis, only a liquidity management issue. The problem is mostly due to cash flow mismatch, not insolvency. The drop in oil prices reduced immediate revenues, but Iraq is maneuvering through tax reserves, treasury fund recycling, bank coordination, the long-term oil contracts and rising oil demand globally will continue to stabilize Iraq's revenues, especially with China's and India's ongoing purchases. The Ministry of Finance's recent agreement with the National Bank of Iraq to activate the Sovereign Guarantees Program has wide-ranging implications, not just for domestic economic development and banking reform, but also for how investors interpret the future of the Iraqi dinar, IQD, and potentially the Vietnamese dong, VND, in the broader context of global currency, realignments and revaluations. 1. Understanding sovereign guarantees and their role in Iraq's financial system. What is a sovereign guarantee? A sovereign guarantee is a commitment by a government to repay a loan or fulfill financial obligations if the primary obligor, in this case, a bank or a borrower, defaults. When the Ministry of Finance provides this guarantee, it essentially puts the full faith and credit of the Iraqi state behind the transaction. Why now? The Iraqi economy is undergoing a pivotal shift. Iraq is trying to attract foreign investment, build infrastructure, reduce dependence on oil, strengthen the private banking sector. Sovereign guarantees lower the risk for international lenders and investors, enabling Iraqi banks to secure long-term loans from foreign institutions, local businesses to access affordable credit, large infrastructure and industrial projects to move forward. This program marks a transition from oil-funded state spending to private sector-led investment, supported by trusted financial channels. 2. Linked to the Iraqi dinar, IQD, revaluation. The Sovereign Guarantee Agreement supports the macroeconomic environment necessary for a revaluation, RV, of the Iraqi dinar, even if indirectly. Here's how. A. Strengthening the banking sector for monetary reform. The Central Bank of Iraq, CBI, has repeatedly emphasized that a modern, compliant banking sector is prerequisite to currency reform. Sovereign guarantees will enable banks to manage risk better, build relationships with international banks, create the financial infrastructure needed for future FX, liberalization and revaluation. B. Support for long-term capital projects. Large capital projects, industry, energy, housing, demand stability. By reducing financial risk for investors, Iraq increases the velocity of capital inflows. Confidence in the currency system grows. Pressure on parallel markets, black market FX, declines, narrowing the official parallel rate gap, one of the IMF's benchmarks for IQD reform. C. Enabling FX policy modernization. The CBI has been moving toward an FX regime that aligns with IMF Article 8 obligations, sovereign guarantees, stabilize expectations, allow the CBI to strengthen its reserves, create space to adjust the official exchange rate once macroeconomic stability is proven.